Welcome back to Market on Close. Let's get into some more of those numbers here. Oof, bears are terrified by the action this afternoon. Keith Gangl joins as portfolio manager at Gradient Investments. Keith, Meta's ripping right now, double digits after already getting to highs a couple months ago. Looks like the market likes what it saw from Amazon too. What stands out to you?
Yeah, like you said, Meta's fantastic. A double beat when you beat on the revenue, beat on EPS. Talk about throwing a dividend in, maybe a potential new shareholder base. Last year was a year of efficiency for Meta, low multiple stock, re-rated higher. Now it's kind of fair valued at 22 times. It's fantastic. With this upside of the numbers, I think the stock can continue to work. That's a standout here. Amazon also a great quarter as well. So these are two great reports after the close tonight.
Okay. Bear killer, I mean, this is pretty big stuff, especially after the market laughed at Powell's idea of cutting in March. So, I mean, what's the downside here?
We like these names. We think they'll continue to work higher, and especially if they start putting up these kind of numbers. Free cash flow. Amazon went from negative last year. I think the number I saw was 37 billion positive free cash flow. If they go at the estimates for this year are 60 billion to 80 billion, that would be 10% of the overall market cap. So these two names are in a great place going forward. Even if the economy slows, I think these new names do well. And what the Fed did, 2 days ago, I don't think it should impact these two kind of companies at all.
Wow. All right. What do you think right now at this point? We've heard from Powell. We've mostly seen the numbers. I mean, we do have a jobs print tomorrow, but in the grand scheme of things, are these figures from these companies what will be driving the broad market?
You nailed it. I think these are going to be the drivers of the overall market. We were more skeptical. We didn't think that the Fed would actually be cutting in March, and they kind of clearly came out yesterday and said they're not going to cut, and that's what we assumed. So I think people are starting to come more to our camp. The odds of probability of went from 80% to a cut in March to sub 50 yesterday, and it's even lower today. So we don't think they cut in March. We don't think they need to cut, but the economy is growing very fine the way it is right now. So we think these companies can continue to do well, especially these two mega cap leaders here.
We just saw Meta punch out a dividend for the first time. Seems like a pretty profound coming of age thing. Might we see some of that from other companies in this category that was once associated with burning growth? Now they're paying us a dividend?
I don't think so, but we could. But I think Meta's in a good place to do it, right? I mean, last year, year of efficiency, so they're getting religion on how to spend that free cash flow, and they're going to like that. They'll attract a new shareholder base. Again, the multiple is not that high for a growth company at 22 times next year with upside to numbers. You're probably more like 20 times. Stock's growing 20 to 25 times, so a peg less than one. This is a good name to be owning.
All right. Do they all belong in the same part of the fund? Do they all kind of justify the skew in the index? I mean, do we need to have balance today, or is this just the natural order of things? And there's a lot of people that argue the skew of the market getting back to like .com level concentration is a bad thing, but is it?
Yes and no. We look at the Mega 7, they make about 28% of the overall market cap of the S&P 500. So that's kind of what we look at, and how should we weight ourselves relative to that? We own some of these names that we're actually overweight, kind of names we really like. And three of these names would be, Amazon. We think great quarter. I think that's going to do well. Meta's another one. I think those are two very good names to own. Microsoft, we're kind of, market weight neutral, but that's still a big position. Names that we don't like so much are names like Tesla. That's a name we don't own right now. So again, I think you have to be selective within that Magnificent Seven, but there's still good names to own. I do think the market, so you're kind of getting to, does the market broaden out? I think it does broaden out. And there's some other names you should be looking at. There's other names in technology. There's, good quarters, stuff in staples like Procter Gamble had a good quarter. There's other places to be as well.
Thoughts on Apple coming out next? This is obviously one that's had a little bit of a tougher go this year. Started off with some negative commentary, but it's held in there. We're pretty close to the records we put in last year.
Yeah, and when we rank or this in our Magnificent Seven, we'd put this closer to the bottom. This is a name we actually took some profits last year. We still own it, but we trimmed. Same reason some of the downgrades earlier in the year. We thought the stock was getting a little bit ahead of itself. If you look at the earnings last year for Apple, it was pretty disappointing. It was flat. Revenue is barely growing. For a company that actually returned 49%, the stock was up 49% with those kind of underlying fundamentals. We thought it was a little too much, so we actually peeled it back. And that's what we saw some of those downgrades on. Now, going at this point in time, we think Apple's growth is going to be kind of flattish for the next couple of quarters, so there's nothing to get excited about. But that being said, service business getting bigger for Apple, it's not a name that you don't want to totally discount because they start surprising on the upside. That's a name you want to get back into.
Okay. Like that. Always like the ranking helps us kind of figure out how to think about these things. So Tesla at the very bottom, Apple not at the bottom, but behind the ones that we're looking at this afternoon.
Yep, you nailed it.
Okay. Keith, thanks for the thoughts. Like the transparency on the trading too, and who you like, who you don't. Appreciate it. Thanks for being here.
Thank you.
Keith Gangl, portfolio manager at Gradient Investments.